Kaspi.kz, Kazakhstan's dominant financial super app. Overall verdict: yellow. Watch. Kaspi was founded in 2008 in Almaty, Kazakhstan. It transformed from a consumer lender into a mobile super app, combining payments, an e-commerce marketplace, and fintech in one app. By the end of 2025, 76.5% of Kazakhstan's population were active monthly users, 15.7 million people. Kaspi and Halyk Bank together process over 85% of the country's cashless transactions. The company listed on the London Stock Exchange in 2020, then on Nasdaq in January 2024, at a $17.5 billion valuation. In January 2025, Kaspi closed a $1.13 billion acquisition of Hepsiburada, Turkey's leading e-commerce platform, the central question for its next chapter. Price versus intrinsic value. Current price, $89.67. DCF base case, approximately $118 per share. A 24% discount to intrinsic value. Cash return, 6.1% free cash flow yield, versus 4.3% on the 10-year Treasury. But free cash flow understates earning power here. Loan book growth counts as a cash outflow for a lender, not a cost. On an earnings basis, the yield is 12.9%. Bull case, $149, if Hepsiburada integration succeeds, and litigation risk fades. The 13% discount rate reflects real emerging market risk. Four numbers define Kaspi. Return on assets, 9 to 12% every year for 7 years, versus 1 to 2% for a typical bank. Revenue CAGR, 39.9% over 7 years. Active users, 15.7 million, 76.5% of the population. Cashless transaction share, over 85%. This is not a bank earning bank-like returns. This is a platform earning platform economics. Phase 1 Forensic Screen. 3 of 8 signals triggered, plus 1 qualitative governance flag. The 2021 operating cash flow trough is loan book growth, not a red flag. Standard for a fast-growing lender, whose loan originations count as operating outflows. Gross and operating margins swung sharply, near 90% in 2021 and 22, back down to 73.5% gross margin in 2025. The 2025 operating margin compression is confirmed. Hepsiburada consolidating for 11 months of the year. The 2021/22 spike itself was not independently confirmed against primary filing text. Return on assets stayed 9 to 12% throughout, the clearest evidence the numbers are real. The genuine risk, September 2024 sanctions allegations from a short seller, and a related securities class action, unresolved. Phase 2 Financial Analysis. Revenue, $0.52 billion in 2019, $7.81 billion in 2025, 39.9% compounded annually, extraordinary for a company this size. Growth has been overwhelmingly organic, rising penetration of the super app across Kazakhstan's population, plus cross-sell between payments, marketplace and fintech. 2025's 56% growth blends continued organic growth, with 11 months of Hepsiburada revenue. Near-ceiling domestic penetration means future growth, increasingly, depends on international expansion. Margin trend tells the real story here, and the data itself required a correction. Gross margin, 66.8% in 2019, spiking near 92% in 2021 and 22, then normalizing to 73.5% in 2025. Operating margin followed the same arc, 45% peaking near 83, then 32.9%, as Hepsiburada's lower margin e-commerce business consolidated. The 2025 compression is explained. The 2021 spike is not fully explained, and is flagged for direct follow-up against the filing text. DuPont decomposition. Return on equity ranged 42 to 86% across 7 years. This is structurally inflated by bank-style leverage. Total liabilities ran 3.4 to 6.5 times equity, not moat evidence by itself. The more diagnostic figure is return on assets, 9 to 12%, 5 to 10 times a typical bank's return on assets. Financial leverage has been declining every year, 7.5 times down to 4.4. Kaspi has been deleveraging even as the loan book scaled. Phase 3 Moat Assessment. 8 of 9 10-minute test filters pass. Verdict WIDE-Moat. The evidence, 76.5% of Kazakhstan's population as active users, and over 85% of the country's cashless transactions. That is a genuine, national-scale, three-sided network effect. Payments, merchants and fintech reinforcing each other. Halyk Bank has matched Kaspi's features for years without dislodging its share. Evidence the domestic moat is durable, not just a temporary lead. The caveat, this evidence is entirely domestic. Hepsiburada is the first real test of whether the model transfers to Turkey, where Kaspi is the challenger, not the incumbent. Phase 4 Capital Allocation. Verdict Yellow. Kaspi is founder-led. Mikhail Lomtadze has run every major capital decision since co-founding the company, including the entire super app transformation. Dividends historically ran 50% plus of net income. Then the 2024 final dividend was deliberately waived to self-fund the $1.13 billion Hepsiburada deal. A 2025 dividend of 850 tenge per share has since been approved, resuming payments in April 2026. Financial debt fell from 80% of equity to 19% over 7 years. The acquisition was funded with cash, not new leverage. Phase 5 Competitive Dynamics. Verdict narrow. Domestically, Kaspi's position is durable, genuine network effects, embedded switching costs from daily use habit, and a scale and data advantage. Internationally, the picture flips. In Turkey, Trendyol is the entrenched leader, and Kaspi, through Hepsiburada, is the challenger without a network effect head start. The verdict is narrow, not wide, at the consolidated level, because a growing share of the business now sits in a market where none of Kaspi's domestic powers yet apply. Overall verdict yellow. Watch. Kaspi combines one of the strongest domestic moats in this analysis series. A super app used by 3/4 of Kazakhstan's population, with 2 genuine, unresolved sources of uncertainty. A sanctions disclosure litigation, overhang from September 2024, and an unproven $1.13 billion bet on Turkish e-commerce. 2025's flat earnings and margin compression are fully explained by the Hepsiburada consolidation. The core Kazakhstan business kept compounding. At a PE of 8.2 and an earnings yield near 13%, the market is pricing in real skepticism about both the litigation and the international bet. Base case, approximately 33% upside to $118 per share, if the domestic moat holds and Hepsiburada integration proceeds without further surprises. 10-minute quality test, 9 filters. Profitable positive operating cash flow, pass all 7 years. Return on equity above 10%, pass 42 to 86%. Consistent EPS, yellow the first flat year in 2025, explained by Hepsiburada. Clean balance sheet, pass financial debt fell from 80 to 19% of equity. Share count, pass essentially flat, capital return runs through dividends. 8 of 9 pass, one of the stronger results in this analysis series. Share count, 192 million in 2019, 190 million today, essentially flat. Unlike most companies in this series, buybacks are not the primary capital return lever here. Dividends are, historically 50% plus of net income. Buybacks were near zero from 2019 to 2021, then modest, $60 to $64 million a year through 2023. The 2024 final dividend was waived specifically to fund the Hepsiburada acquisition, a deliberate 1-year capital reallocation not a distress signal. The 2025 dividend has since been approved and resumes in April 2026. Financial debt, down from 80% of equity in 2019 to 19% today. The more relevant bank-style measure, total liabilities to equity, also fell every year, 6.5 times down to 3.4. The balance sheet has gotten structurally safer even as the loan book scaled. 3 valuation methods. Cash return, 6.1% modest but understated by loan book growth. Earnings yield, 12.9% comfortably above a risk-adjusted hurdle. DCF base case, 13% discount rate, $118 per share, a 24% discount to the current price. Bull case at a 12% discount rate, $149.